aggressive growth strategy is a history that goes back to the early 1980s, actually. The strategy's always been tasked with trying to find long-term investments in sustainable growth businesses. So the idea is to find quality businesses that generate a lot of cash and free cash flow that are run by top-tier management teams that we can hold on to for many, many years. And we're big believers in the compounding of earnings and cash flows over long periods of time. We generally source companies early on in their life cycles, but hold them as they become mid and ultimately large cap businesses. I think that we're best described as being contrarian. We're business owners, we're long-term business owners, and we have some big overweights and some big underweights versus the benchmark. We used to define the strategy as being benchmark agnostic. Today the term is active share, which is essentially how different you are from the benchmark. 100 would be completely different, 0 would be identical to the benchmark, and our active share is about 96%. So versus investors or managers who are very much focused on what's in the benchmark, we're really just trying to buy great businesses regardless of their exposure in the benchmark. A lot of our companies are not even in the benchmark or much smaller positions within than we hold. The term time arbitrage, I think, sums up a lot of what we do. If we're willing to hold a business for much longer than 6 or 12 months, in many cases for 5 or 10 years, gives us an advantage to look through the noise, to really look at what the earnings potential of a particular company can be, and when there is short-term volatility, either associated with hiccups or transitions in business, or economic sensitivity, or simply stock market corrections or advances, we can take advantage of those periods, trying to go contrary to the average investor, go contrary to the consensus opinion. And I think the big gains are really made by finding great growth businesses, but buying more when they get really inexpensive, and maybe trimming or selling a little bit when they get more expensive in terms of valuations. But the turnover in the product being about 5% per year really speaks to the time horizons and the investment time holding periods that we have for a lot of the companies that we own.